Auditing is a core paper for BCom 6th semester. Auditing is a process done after the preparation of the final accounts. The final accounts are prepared by an accountant, but auditing is done by an outsider party who is not prepared that accounts. The word audit is derived from the Latin word audiere, which means to hear. Because in olden days, some persons are appointed as an auditor, and the accountant will say about the preparation of accounts, and the person who is appointed as auditor will hear the same. So such a person is known as auditor. It is the systematic and scientific examination of accounts of a business. It is performed with the ultimate objective of testing the accuracy and correctness of accounts. There are some definitions given by various persons. One is by Mr. Montgomery. In his words, auditing is a systematic examination of the books and records of a business or other organization in order to ascertain or verify and to report upon the facts regarding its financial operation and the result thereof. R.B. Bose defined auditing may be said to be the verification of the accuracy and correctness of the books of accounts by independent persons qualified for the job and not in any way connected with the preparation of such accounts. It means that it is done by an outsider party who is not related to the preparation of account, and it is a process of verification of the accuracy and correctness of the books of account. So what are the main objects of audit? The original object of an audit was principally to see whether the accounting party has properly accounted for the receipts and payments of cash. There are some subsidiary objectives also. One is to detection of errors. Second one is detection of fraud and prevention of errors and frauds. Errors is an unintentional mistake. There are various errors: clerical errors, error of principle, compensating errors, error of duplication. Clerical error means the error done by the clerk. It may be clerical errors include error of omission, error of commission, etc. Error of principle means we are violating the accounting principles. Compensating error means once a error is committed and another error committed which neutralize the first error. Error of duplication means we are doing errors again and again. That is error of duplication. Detection of frauds. A fraud is not an unintentional manipulation. It is an intentional manipulation. It is an intentional manipulation performed for unlawful gains. Fraud may be mainly of the misappropriation of cash or misappropriation of goods, manipulation of accounts, etc. Intentionally they are doing some mistake. In the case of errors, they are doing unintentionally, but in the case of fraud, they are doing intentionally for misappropriating cash or misappropriating goods, or they are manipulating the accounts. The third one is prevention of errors and frauds. Having detected the errors and frauds already committed, the auditor can only suggest the way to prevent their future occurrence. They are giving some suggestions. The implementation is done by the client. The client means who is appointed, the auditor is appointed by some other persons. So that persons, the board of directors, their responsibility is to implement the suggestion made by the auditor. This will help in the prevention of further occurrence of errors and frauds. However, the visits made by the auditor to check the accounts also a moral influence on the persons responsible for the maintenance of accounts. They are visiting occasionally and sometimes a surprise visit, so they will not do any frauds. They will think that the auditor will come and they will find out the mistakes or fraud done by the accountants. This also helps the prevention of further occurrence of errors and frauds. So what are the qualities of an auditor? First one is, he should be well versed in the principles and practice of all aspects of accounting. He must have the ideas about the principles and practice of accounting. He should have a thorough knowledge of the principles and practice of auditing. He should also know the technical details of the working of the business whose accounts he is auditing. He should have a thorough knowledge of company and mercantile law. He should be familiar with the principles of economics and the economic laws. He should also have a knowledge of industrial management, financial administration, and business organization. So what are the preparation before an audit? To carry out an audit promptly and efficiently, much planning and preparation is required. That is, he should have the ability to do the audit, but he must have some preparation. The first one is determining the scope of the work. Second one is acquiring the knowledge about the business. Third one is issuing some instruction to the client. Division of work among the audit staff. Determining the scope of work. Acquiring knowledge about the business. What type of business? Issuing instruction to the client. Give some instruction to the client. And dividing work among their staff. The next point is internal check. Internal check. It is not like an audit. Internally checking. It is an arrangement of the duties of members of staff in such a manner that the work performed by one person is automatically and independently checked by another. In order to reduce the errors, one work done by some person and the next stage is given to the other person. In the second stage, the second stage person also will check the items which is done by the first party. So he can find the mistake made by the first person. Spicer and Pegler state that a system of internal check is an arrangement of staff duties whereby no one person is allowed to carry through and to record every aspect of a transaction, so that without collusion between two or more persons, fraud is prevented, and at the same time the possibility of error are reduced to a minimum. So the persons have the idea that if we committed a fraud, the next person will find out the fraud. So they will not do any fraud or mistake. So what are the main objects of internal check? To allocate duties and responsibility of every clerk in such a way that he may be held responsible for a particular error or fraud. To minimize the possibilities of errors, frauds or irregularities. To detect error or fraud easily if it is committed, as in an efficient system of internal check, there is provision for independent checking. To enhance the efficiency of clerks in a business, as the assignment of duties is based on the principles of division of labor. To distribute work in such a way that no business transaction is left from recording. To prepare final account with ease and efficiently, as an efficient system of internal check can make accounts more regular and reliable. To prevent the misappropriation of cash or goods by any clerk by keeping a check on the receipts and payments of cash and the receipts and delivery of the goods. So what are the difference between internal audit and statutory audit? Internal audit means the person inside the organization. But in the case of statutory audit, a person outside the organization appointed, probably he is an chartered accountant. So what are the main differences between internal audit and statutory audit? First one is, in the case of appointments, internal auditor is appointed by the management, while the statutory auditor is appointed by the shareholders. About the qualification, internal auditor need not possess the qualification as laid down under the Companies Act, but a statutory auditor must have a statutory qualifications. What about the status? Internal auditor is an employee of the company. The statutory auditor is not an employee. He is a professional person having chartered accountant qualifications. What about the conduct of audit? Internal audit is a kind of continuous audit, while a statutory audit is generally conducted after the preparation of the final accounts. Because in the case of internal audit, an internal auditor is an employee of the organization, so he can continuously audit the books of account before the completion of the final account. But in the case of statutory audit, he will come after the preparation of final accounts. What about the scope of work? The scope of the work of the internal auditor is determined by the management, while the scope of the work and the responsibility of the statutory auditor are determined by statute. What about the objectives? An internal auditor has to point out whether any error or fraud has been committed, while the statutory auditor has to report that the balance sheet and the profit and loss account of the company have been drawn up in conformity with the law. Determination of duty. The scope and duties of an internal auditor can be reduced, while it is not so in the case of statutory audit. Reporting. Internal auditor has no responsibility to submit the report to the shareholders, but the statutory auditor has to submit the report to the shareholders. Application of Chartered Accountant Act is not needed in the case of internal audit. Removal. Internal auditor can be removed by the management. or the directors, while a statutory auditor can be removed only by the shareholders and not by the management or directors. What about the responsibility? Internal auditor acts as a watchdog for the directors, while the statutory auditor has to act as a watchdog for shareholders. The remuneration of the internal auditor is fixed by the management, while the statutory auditor, his remuneration is fixed by the shareholders. About the attendance at meetings, internal auditor has no right to attend a meeting, while the statutory auditor has the right to attend a meeting. Vouching is an important point. Vouching means comparing with the receipts. A voucher is a documentary evidence in support of a transaction. The act of establishing the accuracy and authenticity of entries in the accounts book is called vouching. It is an important part of auditor's duty to certify as correct the transaction as recorded in the books of accounts. The accountant of a business is responsible for passing entries in the books of prime entry. The question arises how and on what basis such entries have been passed. The auditor's primary duty is to check these entries and only then certify the accounts as correct and free from any error or fraud. Ronald A. Irish defines vouching as: vouching is a technical term which refers to the inspection by the auditor of documentary evidence supporting and substantiating a transaction. So, what are the vouchers? A voucher is a documentary evidence. They may be of two types. One is primary. Primary means a written evidence in original is said to be the primary voucher. That is invoice for a purchase. The other one is collateral. When the original voucher is not available, copies of there is produced in support. Such a voucher is usually known as collateral voucher. Some examples of vouchers are cash receipt, carbon copies or receipts, contract and minutes correspondence, etc. Cash payment, invoice bill, demand note, wages sheet, salary register correspondence, etc. Purchase, invoice, goods, inward book, copies of order received, correspondence, etc. What is the vouching of cash payment? Regarding the cash payment in general, the auditor should see that the payments has been actually made for the business itself, or relates to the period under audit, or it has been made to the right person, or it is properly sanctioned, or it is properly recorded, or is supported by a proper voucher, and the particulars given in the voucher tally with those of the cash book. What do you mean by verification of asset? Verification of asset implies an inquiry into the value, ownership and title existence and possession, the presence of any charge on the asset. So the auditor has performed 4 types of functions in verifying the asset: to see that they are clearly stated in balance sheet, to ensure that they are in existence on the day of the balance sheet, to verify that they are the property of the business and as such they are free from any charge or mortgage, to satisfy himself that they are properly valued. What are the liabilities of an auditor of a company? The auditor of a limited company is appointed under the Companies Act. Therefore, his position differs from that of an auditor appointed by a private concern. His rights, duties, remuneration and liabilities are clearly defined by the Companies Act. The liabilities of an auditor may be broadly classified into two groups. One is civil liability and another one is criminal liability. Civil liability may be again divided into liability for negligence and liability for misfeasance. So what are the criminal liability? According to the Indian Companies Act, the auditor is punishable if he is not fully qualified for the job, or not properly appointed, or he fails to carry out his duties competently. Criminal liability of an auditor arises out of an act constituting a crime. So when an auditor makes a willfully a false statement in a balance sheet or any other document, destroys or mutilates any voucher or document. During the course of liquidation proceeding of a company, an auditor may be punishable in the following cases: fraud, falsification of accounts, suppression of company's asset, or mutilation of books and records. The following facts must be proved in the court of law in order to be hold an auditor criminally liable. That is, that the statement made was false in material facts, that the auditor willfully made such a false statement, that the statement has been made in a written report, balance sheet or other documents. What are the differences between investigation and auditing? Investigation is a thorough scrutiny of the books of accounts for a particular year or a number of years. Auditing is a kind of test checking. Investigation is done on behalf of the outsider who wish to know the financial position of the business, some days by the shareholders suspects some frauds. Auditing is conducted on behalf of the shareholders or owners of a business concern. Investigation is not compulsory under law, but auditing is compulsory. Legally, it is compulsory for a joint stock company to audit the accounts. Investigation may cover the accounts for a period ranging between 3 to 7 years. Auditing usually covers a single financial year, maybe for 6 months or 1 year. Investigation report is sent to the party who appointed the investigator. The report of auditor is sent to the managing director or chairman of the company. What are the objects of investigation? Investigation of accounts of a business will be conducted under the following circumstances: when a person, firm or joint company intends to purchase a running business, when a person desires to become a new partner, when a person intends to lend money to a business, when fraud is suspected, when a person intends to buy the shares of the company, when it is suspected that the affairs of the company are not being managed, when the acquiring company wants to ascertain the amount of compensation payable on the compulsory removal of business. What are the rights of an auditor? Rights of access to books of account, right to get information and explanations, right to visit branches, right to attend a meeting, right to sign the audit report, right to be indemnified, right to seek technical and legal advice, right to receiving intimation connected with appointment, right to give representation to the company, right to get a remuneration. So what are the duties of an auditor? Duty to prepare a report, duty to inquire, duty to help investigators, duty to call for information, duty to certify the statutory report, duty to certify profit and loss account and prospectus, duty to sign the report. What are the preliminaries before beginning an auditing? The auditor should go through the preliminaries before he starts the work of an auditor of a company. That is whether his appointment is in order, inspection of documents, books and registers, inspection of contracts, examination of last year balance sheet, obtaining list of books and officers handling the books, inspection of internal check system, examination of certificate of incorporation and certificate of commencement of business. Statutory report and audit of statutory report. Section 145 of the Companies Act 2013 states that the auditor should sign the audit report. The Companies Act provides that every public limited company must hold a general meeting of the members with a period of not less than 1 month and not more than 6 months from the date of the company is entitled to commence business. Such a meeting is called statutory meeting. In the case of private company, it is not required to hold a statutory meeting or prepare a statutory report. According to the Act, the board of directors must send a report to the shareholders at least 21 days before the statutory meeting. Such a report is known as statutory report. This report should be certified as correct by not less than 2 directors of the company, one of whom shall be a managing director if there is one. What are the contents of a statutory report? The statutory report must state the total number of shares allotted as fully paid and partly paid. In the case of partly paid shares, the amount paid up must also be stated. The consideration for which shares have been allotted, the total amount of cash received by way of allotment, an abstract of the receipts and payments of the company at the date within 7 days of the date of the report and particulars of cash in hand, an account or estimate of the preliminary expense of the company, name and address and occupation of the directors, auditors, managers and secretary of the company, particulars of any contract to be submitted to shareholders at the general meeting, the extent if any which may underwriting contract has not been carried out and the reason thereof, the amount of arrears due on calls, the particulars of any commission paid or to be paid to any manager or director or agent in connection with the sale or issue of shares or debentures. Thank you.